Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and I am back with Gaurav Sodhi. Gaurav, we couldn't make the podcast a fortnight ago, which was ably hosted by Graham. We were at the Eagers AGM. How are you doing this morning?
I'd say more hosted by Graham. But yes, we're well. We should talk about the AGM at some stage, right? We had a pretty interesting time. Learned a lot.
Yeah, we should. Maybe we'll see how much time we've got left at the end after we've spoken about our two subjects, which are SpaceX IPO and the general.
Graham is entirely too clever and too witty to host a podcast. Every time he tells a joke, it takes me 3 minutes.
I'm taking that personally. I am taking that totally personally. And we've got Nick there. You heard Nick's voice in the background there. He will be leading the discussion on SpaceX, the crazy IPO, and Gaurav's going to talk about BHP. And then this rather dumb and unwitty host will probably have time to squeeze in a little chat about the Eagers AGM. So, but first, let me, in relation to the SpaceX IPO, have a guess. How much money was raised on the US IPO market last year in billions?
I reckon 20.
20 billion?
No.
Yeah.
I'm gonna say it's got to be a lot more. 80.
Okay, you're in between. It was 44 billion. It was 20 billion in 23, 30 billion in 24, 44 billion in 25, and somewhere around 300 billion this year because of the float of SpaceX, OpenAI, and Anthropic. Possibly this is going to be like, so it's 9 times the amount of money was raised in last year is probably going to be raised with the floats of these 3 AI-driven businesses. Nick, tell me what the hell is going on here, because we both looked at the SpaceX IPO. We wrote a very scathing story on it. Is this just a SpaceX thing, or is it something altogether different?
Well, it's not just a SpaceX thing. I mean, I guess we'll speak about the lunacy of the SpaceX IPO in a second, but I mean, there's lunacy going on elsewhere as well. Like, you have Google coming out and raising equity. I don't know if you guys saw that. They've raised $80 billion. Over the last 3 years, they've been buying back stock. Like that's how much. Like, everyone is going all in on this. You have the NVIDIA CEO saying that Marvel, which is a chip company, could be the next $1 trillion business, and overnight that stock is up 30% just from that comment. But like, this is what you sort of start to see at, I mean, the upper stages of a bull market.
Yeah.
There's huge questions, I think, on whether all this capex will generate an adequate return. I think for some businesses it potentially will, but there's a lot of businesses in between at huge valuations where it might not. And that's not me saying that AI isn't going to have dramatic changes. I think we've been pretty clear with members and on the podcast that we do think AI is going to change the world in some aspects. But there's the amount of money and I guess also the amount of the lack of time to get this return because the money's going to the ground so fast is just it's sort of I've never seen anything like it. And I've been chatting to a few people that were sort of around in the dot-com boom. Be interested to see what you guys think. And they said this time is just, it's completely gone to another level in terms of the actual economic impacts going on as well.
Yeah, Gaurav, what's your view on that? Does this
we
seem
were
familiar
around
to
for the
you,
dot-com
or is it?
boom? John, you and I were certainly around for the dot-com boom, if you recall.
Yeah, absolutely.
So I remember it well.
Yeah. Same here. It seems familiar. It seems like a good parallel to me. Even if you look at the comparisons, if you look at the stock market concentration around the time of the dot-com bubble in the US, it was about 41%. So the TMT sector, telecoms, media, and technology sector, accounted for about 41% of US market cap. Right now, the AI Big 10, which is the Mag 7 plus Broadcom, AMD, and Micron, is about 40% of the US market cap. It's going to be a lot more than that after SpaceX, OpenAI, and Anthropic float. So when you look at the comparisons, this is on the verge of exceeding all of the previous bubbles that we've seen in the past 100 years. Maybe the past 200 years, once this happens and gets us back to with the biggest bubble of them all, which was railway mania in the 1830s, when railways accounted for about 63% of total US stock market. So to me, I think the parallels are pretty strong. You look at the way that people are talking about this, the excitement around it. It's got all of the hype. It's got an incredible narrative power. And unlike the dot-com bubble, there's actual real revenues being generated here, which gives it added oomph. What's your view on the parallels there, Gaurav?
It's certainly harder to recognize. I mean, I was only a university student in the dot-com boom, and I was investing my own money, and I was very unsophisticated at the time, not like the sophisticated you see in front of you now. But even I recognized at that point that this was a crazy bubble, because the valuations, you could just tell that was a bubble because the valuations were crazy. The multiples had expanded. There were new metrics invented to justify the prices. Do you remember market cap per view? There was a metric, something like that, where companies would be valued depending on how many views their website would get. Eyeballs, thank you. Yeah. And that was classic bubble behavior. You had these massive PE expansions. I think what makes this one so insidious, and I'm hesitant to call it a bubble, actually, because it's not the valuations that are bubbly, it's the profit margins. So Nick, you would know very well, next year, the big chip companies, the Korean chip companies, the American chip companies, they will be the most profitable businesses in the world next year. And their PEs are sort of single digit. Very hard to claim a bubble when you have single digit PEs, but I think what is bubbly are these margins. I mean, Nvidia is now making, 70, 80% net margin, something outrageous like that. And these chip makers are doing similar margins. And this is a famously cyclical business. If anyone has been around for a couple of decades in the markets, you will see these enormous waves of cycles coming over chip prices. And this is just another cycle, but this is a particularly enduring one because it's got this long structural demand tailwind happening in the name of AI. But supply catches up. And these chip makers are now investing lots of money in new supply. There are new entrants entering the markets, and I think that's where the bubble is. It's not in the valuations; it's in the profit margins, and the ultimate profits are just too high. It's very rare that you see sustained margins at these levels for any length of time, and I think that's where you'll see the crunch point. Margins will come down, and all of a sudden, a PE of 5 becomes a PE of 25, and it's probably not a disaster, but the once the growth stops and people start exiting, and then 25 is too high. These things have a momentum of their own one way, and when the story changes, the momentum goes the other way. So I can see how this is going to unfold. As I said, I don't regard this as a traditional bubble, but I think these profit margins and this level of profitability is completely unsustainable, and I don't expect it to last. Where you do recognize the bubble, John, I think is what you were talking about in the behaviors. So the Marvel jumping by 30%, crazy spikes for silly reasons. all my friends, especially my doctor friends, are buying semiconductor chips and rubbing it in my face.
A massive sign.
That's the sort of behavior I saw in the 90s, and I'm seeing it all over again.
It's
getting
like the
awfully
dentist
tempted
doing foreign
to buy.
currency trading. You know, like
Yes,
it's exactly the same thing at ANZ. You know, all the dentists were in it big time. Yeah,
every time
I think the behavioural signs are more significant than the financial ones.
Yes, and they're the consistent ones, the behavioural signs, and you're seeing those across the board. So that's where I'd see it, and it's particularly strong in those chip makers. I think these big hyperscalers that are spending the money, you know, the Microsoft, the Amazon. I don't think there's no bubble going on there. These are the best businesses in history, and I think they just get more dominant from here. And you know, we have prices where we'd love to buy Amazon, Microsoft, and the rest of them, but it's these semiconductor chips. This is where the fervor is, and I think that's where the danger lies.
Nick, so what's your view on, let's talk about SpaceX specifically, because I think listeners will have a lot of questions about this as an investment opportunity. We're pretty clear about why you shouldn't go near it. Do you want to give us the sort of the elevator pitch as to why SpaceX IPO should be avoided, even though the price might fly on listing?
Yeah, I mean, so I guess SpaceX is three businesses. So it's the rockets, the original business, SpaceX, and you know, Musk deserves a lot of credit there because they've been able to dramatically reduce the cost of bringing, I think, a kilo of cargo is how they measure it into space. I think it's gone down 94%, and if their next rocket is successful, it would go down 99% since they started in 2002. And that's been an amazing engineering marvel. And that's allowed, as the cost goes down, like in other industries, it allows all these new applications and use cases to evolve. And one of those is Starlink. And Starlink, look, if we were just looking at this IPO and we said, you've got SpaceX and you've got Starlink, and Starlink, sorry, is essentially a telco, a satellite telco that can provide internet to people in remote and rural communities that haven't previously had access to it, and offer the same quality of service that you might get in city centres. If we were just talking about those two businesses in this IPO, I'd be like, oh, no, there's a price I'd pay for this business. It's a pretty good business. Starlink's
an amazing company. Amazing company.
Yeah, but it's not. The third part of the business is this AI business, and this is what they're really selling. So I think without Musk and without AI, this IPO wouldn't be happening, and it certainly wouldn't be garnering a $2 trillion valuation, or close enough to it. But the big reason, I guess, we're skeptical is AI is the biggest opportunity, but also their worst business. It's the one with the smallest moat. So it includes their computing infrastructure business, which is sort of data centers. It's almost like a little hyperscaler itself to a degree. It includes X or Twitter. And it also includes their AI model, which is Grok, which is really distributed through Twitter. And if you look at each of these businesses, they just lack so much scale compared to their competitors. So if you look at their AI model, Grok, it pales in comparison to Claude in importance. It trails ChatGPT and Google in users. If you look at X, it trails Facebook, I think even Snapchat potentially, and other things like YouTube for actual engaged users. It's also burning a lot of money. And then if you look at their hyperscale or their data center side of the business, it's far behind something like Amazon Web Services or Google Cloud or Microsoft. So in each of these categories, the business just essentially sucks. There's no really way to,
that's a technical term for it, right?
Yeah. And there's a huge CapEx bill that comes along with all this AI ambition. They burnt $9 billion in the first quarter. Last year, their free cash flow was negative $14 billion, and they're raising or hoping to raise about $75 billion and using that to roll out these sort of data centers and new models and hopefully grow into this opportunity ahead. But when you look at their competitors, well, I just think it's very hard to see that this is going to work. And they also, like $75 billion sounds like a lot of money. But when Google and Microsoft are spending $200 billion each, it might only go so far before they need to raise more and more money. And so it's not only that the AI opportunity lacks a moat, but it's the fact that they might have to continually reinvest in it to try and keep up with companies that are already far ahead of them. And you marry that up with the price of $2 trillion, and it's just hard to make any of this make sense. And I think the tell here that it doesn't is Elon's really trying to sell this to retail investors. So I don't know if some of our members would have seen it. It's been marketed to CommSec and Bell Potter clients in Australia. It's been marketed to dozens of retail brokers across the world. Robinhood and Charles Schwab in the US, they're big retail brokers. They're now warning investors not to flip the IPO, otherwise they might be excluded from other IPOs in the future. Musk
really?
is
How can they do that? Is that Musk strong-arming the brokers?
No, I think they would mark the client as a flipper and just exclude them. I'm not sure if it's Musk strong-arming anyone, but it doesn't look great. Musk is, though. He's reposting or tweeting how much people have made or would have made if they bought Tesla at IPO. So he's been putting out those tweets over the last couple of weeks, saying, and so this is who it's, being sold to. And that should scare anyone looking at it.
And this is because the institutions don't want it, or they've got enough already? Why is it? Why are retail investors a focus?
Look, I think it's two things. I think the size of it, this is probably going to be, this will be the largest public raise in history. Google just did $80 billion, but put that to a side. This will be the largest IPO, or the amount of money raised at IPO in history. So it's quite large. So you need a lot of, people to sort of want in. And then secondly, I think this drums up hype and marketing it to retail punters is essentially an easier sell than trying to do institutions where they might ask, more detailed questions. There are certainly, though, a number of institutions already invested, and they are saying how I've read a couple of things this week, how they're saying that, this is like buying Google at their IPO. But, that's easy to say if you've got in at a much lower price and will benefit from the stock going up.
Right.
Once it IPOs. There's also certain clauses in there that that institutional investors can sell if the stock goes up by a certain price. I think that there's like hurdles like 10, 20, 30%, and they can sell a bunch of their holdings. So they have an incentive to do it. So there's a lot of common interest for this to work out.
I wouldn't say it's rigged.
It should be said also that
particularly, but this is. Sorry, Gaurav. I just want to mention some numbers in the prospectus, because it's an unbelievable document, and it tells you why there is this. Well, it shows you the extent of the retail focus. It really looks like a sci-fi novel. It could have been done by Isaac Asimov rather than somebody who worked in finance. There's an artist's impression of life on Mars. There's a dozen pages of rockets, and there are 74 references to the moon, 63 to Mars, and 27 to the sun. And the free cash flow metric gets only 4 mentions. It's unbelievable. It's unbelievable the way that this stock is being presented. I find it extraordinary that the SEC allowed this. I find it extraordinary that ASIC have let this go through as well. It just shows you that if you're big and powerful, you can, and you're doing something as big as this, you can get a much more pass than what we originally thought. If this was some, retail funds management company on the Gold Coast that was trying to do this, there's no way that it would happen. But because it's Elon Musk, they're getting away with it. It's incredible to me that this is allowed. That's my rant.
It's not that I don't mind it being allowed. I'm okay with dumb ideas being floated. I can't believe anyone's actually taking this up. Like I I agree. Those numbers are ridiculous. It's almost like, it feels like a prank sometimes that they're just trying to see what he can get away with. Mm-hmm. If I put up the most ridiculous proposal, the dumbest idea, the most outrageous document, will someone still buy it? That's what it feels like. And it's all working. I can't believe people are buying this. It's obviously it's a stupid. It doesn't even matter if it's if it goes up or not. It probably will go up. It's still a stupid idea. I love that. Have you guys heard that? I think it's a Mark. No, it's from Howard Marks. Howard Marks said, if you light a match and run through a firework factory, you're still an idiot whether you make it out alive or not. And that's what I feel about this.
Yeah.
You might make money out of this, but you're still an idiot for buying it. And I think that's just, I don't think we need to go any deeper. You don't need any sophisticated financials, which although John and Nick did provide in the review, which was hilarious and excellent, I might add, by the way, boys. But you don't need any of that. All you need is to know that you'll be all being offered the stock through ComSec on a NASDAQ listed, $1 trillion business. That's not going to be a good idea.
Yeah. I think just picking up on that, Gaurav, is this IPO really underscores the circular funding model of what's going on in AI as well. So Google came out last week, and there was a bit of negative press around the SpaceX IPO, as you can imagine, and essentially announced that they would be signing a deal with XAI that gives them, I think, about $1 billion a month in revenue. It was a cloud computing deal. That contract can be cancelled at 90 days' notice. It will ramp up very slowly, so it won't be $1 billion by month one. And I think it's about a 3-year contract. Google owns 7% of SpaceX. So you have to question at some point, and you're seeing this in other parts of the chain where NVIDIA buys a stake in X company, and then those companies go and buy NVIDIA chips, and it and then they commit to more cloud computing, and Microsoft buys some more NVIDIA chips, and it's a bit of a merry-go-round, and you can see this here a little bit. The market needs this to go well I think, to believe in the hype of AI and to keep the funding rolling. I think it's not a coincidence that Anthropic and OpenAI both have announced that they will be IPOing shortly after this, because if you wait a couple of years or till next year and then people go, hang on, SpaceX is spending all this money through its XAI division and it's not really earning anything. And then your valuation starts to get affected. Why take that risk? Why not just go now when it's, when AI is at sort of fever pitch levels? I think that's an important point here.
Yeah, absolutely. And I think that's a key point. The window is now open for these kind of things to get away, and they need to do it now, because in a year or so, I think the narrative may well have changed and they will be saddled with businesses that they can't get rid of. That will be my reading of it. It's a cynical take, but I am quite a cynical person at these kind of things. And I think traditionally, cynicism is a good way to view an IPO, and that's how I would view these IPOs. We're going to take a short break, and we're going to come back with BHP, which is Australia's new AI company, according to Gaurav's review this morning.
Tax, housing and investing could be about to change in a big way. Following the proposed changes to capital gains tax and negative gearing in the federal budget, Alan Kohler and Intelligent Investor founder John Addis are hosting a live webinar to unpack what it could mean for investors. They'll cover housing affordability, property investing, shares, ETFs, retirement planning, and the risks and opportunities for younger Australians. Join The Rules Are Changing, Tax, Housing and Your Wealth live on Thursday the 18th of June at 1 p.m. Register now at intelligentinvestor.com.au. Places are limited.
Okay, and we're back to talk about Australia's latest AI stock, which is BHP, Gaurav. What on earth is going on here? Why is the world's biggest miner being categorized as an AI company?
Yeah, it's happened pretty quickly, and I keep seeing this everywhere. People keep referring to BHP as Australia's best AI exposure. It's investors, analysts, media commentators. That's where the noise is coming from. And it's not wholly unfounded. One big thing that came out of BHP's last result was that copper for the first time contributes more than 50% of profit. So this is no longer an iron ore driven business. Copper is now the largest segment. And in fact, copper is now the largest grower as well. So the copper exposure of BHP will grow over time. Over the next 10 years, you're likely to see more copper coming out and representing even a higher share of BHP's profit pool. So you can now characterize this far more easily as a copper business than you could a couple of years ago. And there are good reasons why the AI fanboys are all over copper. Because the data center build out, which we're kind of talking about, it's what, Nick? I think it's 700 billion over the next couple of years at least, and then more going.
That's unders.
That's unders. All right. Well, we're talking probably trillions here, right? Then of data center builds. Well, copper is fundamental to building data centers. You need it for transformers, the switchgear, the power distribution systems that are built inside the data centers are all built on copper. And then the cooling functions are all kind of copper-centric as well. Heat exchangers, cold plate cooling, and the chips themselves are wired with copper. So some of the work that's been done suggests that a data center is sort of 5 times as copper intensive as a traditional commercial building, which has plenty of electric copper wiring running through it. And so there is no doubt that with all these data centers going in, that the demand for copper is going to go up, right? And you can see that in the copper price. The 25-year average copper price is about $3 a pound, US dollars a pound. Copper is now trading about $6.50 a pound. Its all-time high is about $6.80 a pound. So it's trading close to its all-time highs. There's a lot of cost inflation, so that sort of 25-year average is probably no longer relevant. I reckon you need about $4 a pound, in my estimation, to make copper work, and it's trading sort of 50% higher than that. So we are already in a world of elevated copper prices, and on top of that, people are putting high multiples on BHP's earnings because they expect those prices to expand or at the very least to continue. And my point is simply that is not the way commodity markets work. Very rarely do you get big demand pushes just lifting the price of commodities for decades. We did have it. There's one example where that has happened, and that's been iron ore. And iron ore is a very interesting test case because before 2003, for the 30 years preceding 2003, iron ore traded at between $20 and $30 a ton, and it didn't move very much. And these were contracted negotiations directly between the buyers and sellers, and you had that $10 range, $20 a ton, $30 a ton. And in 2003, that all changed. And since 2003 up until 2026, the price has averaged about $100 a ton. And that's kind of been a new norm. And it's been a break. And the reasons for that are China's industrialization, but also the dominance of the big 3 iron ore basins, or the big 2 iron ore basins and Fortescue, I'd say. So, and those iron ore basins, if you don't know, are the Pilbara in Australia and the Carajás in Brazil. So most of all the iron ore, seaborne iron ore, just comes out of those basins, and Fortescue provides the rest. So there's so much concentration in iron ore, and because, as my catchphrase, iron ore is a logistics business. It was very difficult to expand supply, and when it did expand, it expanded from existing infrastructure basins. So that might be a one-off. Trying to make the same case for copper is difficult because copper is dispersed geologically. It doesn't have the same infrastructure requirements. Copper is a mining business. It's not really an infrastructure business. It's a proper metals business, which means you need concentrator and smelting. A lot of that happens on site or at sort of regional facilities. It's a very different business to iron ore, and if everyone expects copper prices to rise, and everyone does expect copper prices to rise, they pour billions of dollars into copper capex. And you look at the mining plans of all the big miners, that's exactly what's happening. BHP is spending 50% of its group capex on copper exploration and development. Ditto Rio, South 32, Anglo, Xstrata, all the copper majors, Freeport, all of them are spending at least 50% of their exploration development budgets on copper. There is a scramble for copper going on. And so far, it hasn't yielded very much. But I tend to find in resources, if you follow where the capital is going, the capital tends to precede output. And I have no doubt that the combination of very high copper prices and lots of capital searching for more copper is going to result in lower copper prices. They are the conditions you need to lower copper prices in the future. So I think building a case for BHP based on sort of $6-7 a pound copper, even higher in many models, is a little reckless. It's not impossible, but you're not being well compensated for the risk that the copper prices fall again.
So this looks like it's an AI story, but really you think it's a traditional commodity story where higher prices encourage supply, and when supply increases, then prices tend to come back down.
That's exactly right. The AI crowd are all over this, the fanboys, the propeller-headed fanboys, all over this. But this is just this is Tuesday in mining. This is just another cycle.
That's right. Tuesday in mining.
It's just another cycle.
That's actually a better thing to put on your gravestone than BHP is an infrastructure business. I think Tuesday.
Yeah, so this is just another cycle, and the market's doing what it sometimes does and getting a bit carried away. And I think BHP is an outstanding business. I mean, it's a properly high quality business, and anyone who doesn't look at BHP seriously, a lot of investors like, we don't invest in mining. I think they're fools for not looking at BHP, an outstanding business. But at current prices, you are really praying that copper stays where it is and iron ore doesn't fall. Because if it does, and I went through some of the numbers in the review, those profit metrics, they're not terrible. BHP still makes a mighty amount of profit, but all of a sudden today's share price looks probably 50% overpriced.
So you said in the review that most investors probably have more BHP than they need at these prices. This is a good time to not necessarily sell all of your stock, but some of it. We've got 20 opportunities on our buy list now. We see a very bifurcated market where some really high quality businesses are at their cheapest prices in years, and this is a good time to take some money off the table in BHP and reallocate it to some of those stocks.
Yeah, and what makes it more interesting is that BHP is like, I think it's a 10% market weight. So if you're just holding the market weight, you're holding 10% of your portfolio in BHP. I don't think that's wise. So I'd be knocking that back.
Yeah, just don't put it into Commonwealth Bank. So now let's Nick, have you got any comments on iron ore and BHP? You probably got as much to add to it as I have, really.
Yeah, not a lot at all. The only thing I'd say is, look, I've followed the business on and off for a little bit, but don't understand it to the degree that Gaurav does. But as Gaurav has mentioned in some of his reviews, this is now a far better run business than it maybe ever has been. Like the management seems to be doing really sensible things, and the acquisitions are well thought out. Haven't gone into some of the speculative booms of the last decade, and so they deserve a lot of credit. And that's probably partly in the share price as well. But yeah, can't compete with those AI fanboys.
Okay, all right. I think we're going to leave it there. I'd love to talk about the Eagers AGM because we had a very good time there, and it was an extremely interesting meeting. I think we might have to leave that until for another fortnight, Gaurav, when we can talk endlessly about how much we love Eagers and how well the business is performing and how much the share price hasn't moved since the AGM, which tells you something about this market. But we're going to leave that for another fortnight. We will be back then. In the meantime, please enjoy the break. Please try and avoid the SpaceX IPO and whatever other shit brokers are trying to sell you during this period. And we will see you again then. Thanks, Gaurav, and thank you, Nick.